As India's economic ascent continues to capture global attention, it's important to understand the effect of the strong GDP on common investors. Does this mean stock markets are set for a new high? Should you reallocate or reassess your portfolio to secure the best returns? To give us some perspective on these questions, I have with me Ajay Bagga, market expert. Welcome to the show, Mr. Bagga. Thank you so much for your time. My first question to you would be, this GDP data marks the fastest growth in 6 quarters. How might it shape short-term stock market volatility? And do you foresee the Nifty crossing new highs in response to this?
See, again, GDP, these numbers are a lagging indicator. So mostly this is discounted in the stock prices. Having said that, there is an upward surprise. So definitely the street was expecting anything from 7.2 to 7.5, and it's come in much higher at 8.2. So there is a pleasant surprise which the market will react to on Monday. So definitely it will have an impact. But again, I would say that this is already reflected in the corporate earnings season that has gone by. It's giving us a good indication that there is an increasing momentum in the economy, and the poor show of last year is now leading to superlative performance in the economy this year. So overall, yes, it's a positive impact, but a lot of it is discounted in. The surprise element will lead to a positive market on Monday.
According to you, while most of this GDP print may have been discounted and is already penciled in because it comes a bit later, I'd like to ask you, with India's Q2 GDP growth at 8.2%, driven largely by manufacturing and services, how do you see this translating into improved corporate earnings for India Inc. in the coming quarters?
Yeah, a very good question. And overall, what we are factoring in is that the trough has happened in June in terms of the growth of the corporate earnings. September numbers were a little better. And what has happened is the downgrades have plateaued now. So what we were seeing right from last September onwards, when the earnings started falling off the cliff, and there were more downgrades than upgrades. September has been the trough on the downgrades. Second half of this year will be much better than the first half. And then the next financial year, FY 2027, will be even better than 2026. So that is being borne out by the GDP numbers. The concern remains on the nominal GDP, because the budget had factored in a 10% nominal GDP growth. With the inflation falling off, the nominal GDP is not growing that fast, and that has a consequence for the tax revenues for the government. So despite inflation being so low, we have done a pretty good performance on GDP, but RBI needs to look at this data. Our interest rates on a real basis remain very high, and I would say this data is supportive of an RBI rate cut next week on the 5th of December.
Okay, but I'd like to also quickly understand from you, Mr. Bagga, you mentioned that while the GDP growth and the low inflation are positive triggers for the markets in a way, why do you think the lag in nominal GDP growth is a key concern? And what kind of effect are you foreseeing for the Indian stock market because of this?
Yeah, your budget math basically doesn't add up. You were planning on earning at 10%, and you're earning at 8.5 or 8.7%, whatever is the nominal number today. So that gap comes into the government revenues. The good news is they have other sources, and they have been pressing down on expenditure. So the government will manage to meet its fiscal deficit target, but overall the collections for the government are linked to the nominal GDP. So that becomes an issue. In a poor country like India, if you are having more of a deflationary kind of an environment or a very low inflation environment, and the growth is not coming, then all your social parameters get affected, because the government collections are based on the nominal GDP. So the budget had a 10% number. You're not achieving that. That becomes an issue. So the government will likely cut down its expenditure to meet its fiscal deficit target. And that then has issues in terms of future growth of the economy, plus welfare schemes. So that is the concern with these numbers, and that the ball is clearly in RBI's court. They have to stimulate the economy, and they have to look at a nominal 10-11% GDP growth number and not limit themselves to this 8.2% real number. We need that nominal number to go higher at 11-12% to meet all our objectives.
Mr. Bagga, do you think that it's because of the weakness observed in nominal GDP growth, the government's expenditure has dropped a bit? In fact, the government expenditure declined by 2.7% compared to a growth of 4.3%?
Yeah, there has been a talk of government going slow on the non-infrastructure expenditure. So wherever they could hold back, Jal Jeevan Mission, for example, there has been a suspension of total outlays because of the money spent. A lot of corruption was found in that. So that is one outstanding case because the Prime Minister himself spoke about it. But like that, a lot of the ministries are being pressurized now to reduce expenditure to meet the fiscal deficit target. The good news is RBI has a good kitty, so the RBI dividend has helped, and hopefully we will be able to get through without a very strong government expenditure fall. At least the infrastructure expenditure and the defense, railways, all which come under that, I hope those modernization and infra building expenditures stay. But it becomes an issue on an economy wide. So you need that 10-11% nominal GDP to
Got
come
it,
in.
Mr. Bagga. I understand your point of needing a sufficient nominal GDP growth, but bear with me as I try to club three questions into one because we have less time. The article highlights a 9.1% surge in manufacturing output. Then private final consumption expenditure has also improved by a substantial margin. The tertiary sector has also grown by 9.2%. What do you think is going to be the impact of these key figures on auto, IT services, as well as the manufacturing landscape? And do you think investors should go ahead and maybe, I'm not saying invest, but at least look at these sectors now?
Yeah, no, definitely, definitely. We have underperformed as a stock market for 14 months. And historically, after such a consolidation phase, we tend to outperform. So I don't see a problem with the markets. And you will, especially today, the way the market has closed, or even on a monthly basis, it's showing all-time highs. So it's pointing towards strong performance from the market. So investments need to continue. The sectors that are looking very bullish, banking, within that, PSU banks are in a catch-up mode. That should do well. NBFCs are doing very well. We have seen infra performing. Telecom had good results. Cement had very good results. Construction has good results. Entire infra pack is looking good. And going into the budget, normally you have railways and defense rallying. So we are expecting the next 2 months, December and January, you will see a rally in defense and railways in anticipation of the budget overlays. So markets will do well.
Okay. Okay, so PSU banks, infrastructure, telecom, railways, and defense are spaces to look out for. But Mr. Bagga, we have 30 seconds. I'd like to ask you, how will this stronger than expected GDP figure, and especially the fact that Indian markets reached an all-time high just this week, influence foreign investor sentiment towards Indian equities, especially in light of global uncertainties, and could it trigger an increased FII inflow into India?
Not in the short term. Those issues are different. Those are valuation, those are growth in corporate earnings and the rupee levels. Though, and also not having pure play AI plays. So money is going into Korea, Taiwan, China on the AI front, and Japan and Europe on the valuation front. So not immediately, but yes, over time, as corporate earnings also show this kind of momentum as the GDP is showing, you will see a return of FPIs eventually.